Welcome to the Dividend Talk podcast, episode 132, an interview with Bob Lay. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. So sit back, relax, and join us as we dive into the world of dividend investing and discover the power of passive income. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DGI. How are you, buddy?
I'm good. Got back from Ireland last week, right? Visiting you for the first time. And straight away has deep into work. So I actually haven't really done anything on investing this week. Of course, it's a nice thing with being a dividend investor. Everything is automated. So, really nice. But how about you?
Yeah, I've had a nice week. I've recovered from all the Guinness we drank last week. Well, I drank in your absence of drinking it, but yeah, it was fun last week. But good to take a detox and get back to this. And hey, we have a guest on the show today. We're back to Canada. We're very diverse. We've had one Canadian on before, the Dividend guy, but I am delighted to have Bob from Talk on. I hope I'm pronouncing that right. You can correct me, but Bob, welcome to the show.
Yeah, thanks for having me, guys. It's pronounced Talcan.
Excellent. My pronunciation can be a little bit off, particularly in Europe. We've got lots of European names, so please forgive me if I get anything wrong. But maybe just before we get started into the news of the week, Bob, if you could just give us a brief overview of who you are and what you do, just for some of our European audience.
Sure. So my name's Bob. I'm from Canada. I'm second generation immigrant. Came to Canada with my parents when I was a teenager. I was born in Taiwan. I've been writing on my blog, talcan.com, for, I think this year is the 9th year. So in blogging world, that's like eternity, basically, right? So
ancient.
So it's, I've been around and I primarily do blogging and appear on podcasts and videos here and there. It will be fun talking to you guys.
Yeah, and I must also compliment you for that, because I think I started dividend investing in 2014, and it was Jason Fieber at the time. And some of the lads, and I also already remember, around those years already visiting your blogs and getting inspired. I think there was one guy that was always sharing all the total dividend income from many bloggers, and I believe yours was also at times on the list.
Right, there was the Dividend Diplomats did that for a while.
Yes,
there was another guy I think he was in Europe that was sharing that every month as well.
Polly's Dividend, I believe.
Yeah,
Polly's
I
Dividend.
think so. Yeah.
Good old days of the dividend investing community via blogging.
Mm-hmm.
Awesome. So, excited to get to know your story and chat to you a little bit. Usually at this stage, we talk a little bit about what's been in the news, anything of interest. So I don't know if you have anything, but I suppose today the big thing in the news is obviously the big tech layoffs. Google announced something like 12,000 employees are getting let go, and for some reason I don't know why, but the market reacted quite positively to this. I'm not quite sure why that would happen.
Yeah, I work in the high tech industry, so seeing these layoffs is not uncommon. I've been with my company this is my 17th year, so that's kind of strange to stay that long in a high tech company. But we've been pretty stable. But even within my company, I've seen at least 5 or 6 times a layoff where the company lay off like 10+% of employees, right? So I've gone through that, and it's been interesting to see all these high tech companies letting go employees, right? You have Microsoft, Amazon, Google, all the big names. I think I read Netflix is doing that as well. I think they're just, and one thing to keep in mind is when you see 12,000 in Google, that seems like a very, very big number, but you need to remember their workforce is giant. I think, was it Microsoft or Google? I read they have like almost 250,000 employees in the company. So when it's like 10K is like a pretty small drop in the bucket. But I think these high tech companies are just getting ready for the overall softness in the industry. With the interest rates going up, there's also a lot of concerns about potential recession coming up, right? So they're just doing their usual, call it trimming the fat, I guess, if you put it that way, or just trying to tighten the bill and try to see what they could do, right? And it's pretty natural in the high tech industry to do that, so I'm not concerned though. I wouldn't really read this as either bullish or bearish signal. It's just a matter of tech companies tightening down, anticipating that there are going to be some softening in the upcoming months, years, and really trying to tighten their operational expenses, right? Like, so personally, I could see why the stock market view this as positive, because you're reducing your operational costs, which will increase your earning per share, basically, right?
And thus your dividends.
Yeah, exactly.
Yeah, it's just quite strange though to see news quite like that. Like there's so many layoffs. I know 12,000 is not quite a big number in terms of Google, but it is still a lot of people, and to see it jump 6%. I think 3,000 of those actually are coming from Ireland as well, which is quite a big number, particularly over in a country the size of ours. It's quite big news here, but I certainly wasn't expecting a 6% increase today. I can tell you that. European DJI, anything in the news you have noticed this week?
Well, it's just more funny, right? If you think about just doing business, at the moment the World Economic Forum, I believe, is in Davos, right? So we've got all our billionaires there and the captains of industry. And there was a report coming out this week that there were more than 100 prostitutes sent to Davos as well, and they're actually staying at the same hotels as them. And there was an interview on Dutch television with one of the owners of a brothel, and she mentioned that her ladies are charging 6,000 euro per day to accompany the men there. And that's excluding travel expenses, so they come on top of it. So the hotel room and which are not cheap in that area, plus the flights and everything. So, and then I'm just thinking, like, it's just everywhere. But I was just thinking, like, imagine you're a billionaire, you're married, and they read this in the news that there are 100 prostitutes around there, and you are not allowed to come with your husband. I mean, how would you feel?
It's crazy. I mean, I don't know what to say to this. I wasn't expecting this in the news of the week, but it's as a business model, you got to admire. The gross margin must be pretty high with those.
I think so. This is like a SaaS business model, SaaS margins.
Yeah, it's interesting that this comes out, like some shady stuff going on, I guess.
But also the owner of a brothel just speaking publicly on national television. We charge 6,000 euro per day, and
but it's probably not good for the hotel either. The hotel that's putting these up. I don't know if the name was released, but I'm pretty sure if I was a hotel owner, I would not want news like this circling. Even if I knew or didn't know about it, I would not like that. It's not great publicity, I would say.
For sure, it's not great publicity.
It at least shows that they're all human there. So
Yeah.
that's good to see.
Okay, cool. We do some dividend hikes this week. I think Investor AB has had a 10% dividend hike. They are a Swedish company. I'm not sure if you've heard of them, Bob. I don't know. Do you have them in your portfolio, European DJ?
No, I don't have them.
No, I'm not aware of them.
And there was a Canadian stock as well. Franco Nevada hikes the dividend by 6.3%. So they're the only two we have this week. We usually then do some sort of icebreakers. We do like a rapid fire question round. You haven't seen these questions, so it's an A or B, and you just give us the first answer that comes to your head. And if you want, at the very end, you can clarify your answers. They're not hard, so you don't have to look too scared.
Sure.
The first question is nice and easy. Bank of Montreal, ticker symbol BMO, or TD Bank?
TD.
Okay. Coors Light, which is a Canadian beer, or Carlsberg, which is a Danish beer?
Carlsberg.
Okay. Would you rather win the Stanley Cup or the World Cup?
Stanley Cup. We're Canadian.
Low yield, high dividend growth, or high yield and low dividend growth?
That depends on where you're at in terms of your journey. So for us, would be probably more towards high dividend yield. Well, no, again, it depends. We could talk about that more later.
Okay. Taiwan food or Canadian food?
Taiwan food, I guess.
Cool. And Warren Buffett or Charlie Munger?
Warren Buffett.
Nice. I'm interested to hear your thoughts on the low yield, high growth question.
Yeah, so I did write a post about it. I think it was early last year, and just I'm a spreadsheet guy, so I did some scenario analysis, and the reason I said it depends on where you are on your journey. If you're closer to retirement or you're already retired and you really need the income, then you're probably more focused on the higher yield, lower growth, because you need the income, right? Now, if you're in your early 20s or 30s and you have 20, 30 years ahead of you in terms of this investing journey, you could afford to invest in some lower yield, high growth, high dividend growth stocks, right? Because the growth will take over eventually. So what if it's like 1% or 0.5%? If the dividend payout is increasing by 20, 30% a year, there's going to be a cross point to the higher yield eventually, right? So it really depends on where you are in terms of journey. Now, for us, our goal is to live off dividends. We kind of set a target of 2025, but to be honest, at this point, we're getting pretty close to that if we supplement it with some part-time income. So for us, we're probably more looking at the higher yield aspect, but still paying close attention on the low yield, high dividend payout stocks. Hope that makes sense.
Yeah, no, it makes perfect sense. I kind of agree with you. When you say high yield, what kind of yields would you class as high yield? What's a high yielding stock?
Well, like Canadian market, if you look at it, you could get 4% yields pretty easily. If you look at the US market, 4% is pretty hard to find, right? The US market is usually about 2%. Canadian market, like you look at all the Canadian banks, they're yielding roughly about 4% right now, right? So if you're in Canada, high yield, I would say like 6 and up. Now, some people may fall into the trap of, hey, I want as high yield as possible, get like 10% and stuff, and then you get into these like cover call ETFs or split corp where you're getting 10, 15, 20% yield. That's where it gets really, really dangerous. I almost sort of, my analogy to those high yield, like those cover call ETFs, and mostly on those split corp, it's almost like a Ponzi scheme, right? You're just getting your money back. You're not actually growing your money. So when somebody says, "Hey, I my portfolio yielding 15%, I'm getting, I invested 200,000, I'm getting $10,000 a month." It's like, whoa, hold on a second. Like, do you know the risk involved here, right? So it's you have to look at it from a risk and reward point of view as well.
The issue that I have with, let's say, 1% yielders or 1.5% yielders is that you end up forecasting, let's say, 15 to 20% growth over the next decade. And this is kind of finding this 100 bagger, right? Which is like one out of the whole entire S&P 500 that might be able to do that on a 10-year lifespan.
Exactly. So it also depends on, again, it comes back to your timeline, right? So if you may allocate only 10% of your portfolio to these low yield stocks, or bigger percentage if you're younger. But I would argue if you're younger, you're probably better off investing in an index or equity fund, right? Which you capture the market and then hence select the individual dividend stocks as you see fit.
Yeah. And the question that we often get, and maybe it's already a nice question to ask, like, for instance, I've got Microsoft, right? I bought Microsoft at in the $40 range for the first time. So I probably have like a 4 or 5% yield on cost, but I think I bought it even at a 3% yield or something like that. And now it's, of course, like, was it 1 point something? I often get the question like, hey, why don't you sell it and replace it for a higher yielding? Yeah. So what is your philosophy around this one? If you have at companies that just like went up 4 or 5 times in price, more because of multiple expansion and such, do you keep them and let your winners run, or do you sometimes roam it off and replace it with higher dividend income stocks?
I think it depends on whether you believe in the company or not, right? Like in terms of Microsoft, I think the growth is still there and it will continue to raise dividends, right? For example, we got in Apple very, very early, and where cost on yield is pretty high. I think right now it's like 0.6% yield, but ours is like multiples of those, right? And we kept Apple because we think it'll continue to grow. And I think the danger with dividend income investing is you can't just look at the dividend aspect only. I know some dividend investors say, oh, they only care about dividend income if they're getting $50,000 a year. They don't care if their principal goes down or not, right?
Yeah.
I'm more on the side of I want my dividend income and I want my principal to grow, right? Because if my dividend income is not enough, at least I could sell some principal, right? So when your principal is not growing, you can't. It's harder to sell, right? It's harder to use your principal to supplement your dividend income. So I would say, yeah, in Microsoft point of view, if we have Microsoft, I would just keep it, right? Generally speaking, when we invest in a stock, we tend to hold it forever. At least that's our plan. Obviously, plans change, but for the most part, I don't think it makes sense to switch back and forth between these stocks just because the yield is higher.
Yeah, so I follow the same approach. I just learned to let my winners run, because I once made the stupid mistake to sell McDonald's. I got it at $90, and I thought at $120, oh, it's already overvalued. It was really early in my dividend investing career, let's say. And I just learned, like, it makes no sense to look at it with such a lens. To your point, if the business is thriving and it's growing, then whether it's overvalued, it's actually not really it's a luxury problem, right? The most important is can the dividend grow and continue to grow. And so I'm like stocks like Microsoft and Apple that went like 4 or 5-fold for me. I'm just keeping them, and I really enjoy that. I see, like, let's say the initial dividends, how they look like at the time of investing, that they doubled in those few years, right? And it also is kind of, for me, always a nice proof of that dividend growth investing. And I think that's the point you're making with the emphasis also on growth, is actually really bringing in the compounding. The worst I could do is sell it for kind of such a stock that I regret later selling for a dividend cut or something like that.
Exactly.
Cool. So maybe it's a good place then to take us back to your first day starting. Do you remember how you started investing, and how did that look?
Yeah, I mean, I started investing when I was, I think I had an investing account when I was in university even, and I was just, investing per my dad's recommendation. Didn't really know too much. And then when I graduated from university, started working, I was kind of dabbling around, didn't really know what I was doing. I invested in mutual funds and, penny stocks and, momentum. I took a bunch of courses on momentum trading techniques and, the channel breaking, the seasonality, like all those techniques, right? I would say the very first dividend stocks that I purchased was called ING in Canada. ING used to be like a bank. I think it's actually a Dutch bank, maybe. But the ING listed in Canada was the financial like insurance company. And back then I didn't know anything better. As I was like, oh, ING, it must be the banks. I bought it, and that was right before the financial crisis. So it tanked like 40-50%. But back then ING was yielding about 3%, like yield on cost, I think, right? So I was like, well, if I sell it and take a loss of 40-50%, and then put in GIC, which is the guaranteed income. I can't remember what GIC stands for, but it's basically like the high savings rate account. I would, because back then when financial crisis started, the interest rate went down. So if I were to put the money in GIC, I would maybe get like 2%, 1.5%. So when I did the calculation, I was like, well, I might just leave the money in ING, and I didn't need the money, so I just left it there and collected dividend, and eventually it recovered, right? So ING, if I look at our portfolio right now, I think it changed name, now it's called Intact Financial. I think we are looking at like 3 or 4 baggers for Intact Financial, right? So that kind of early on gave me the idea, hey, dividend investing is great, because even if the stock goes down, the stock price goes down, I could afford to just wait. Like if I don't need the money, I could just afford to wait and collect the dividends, and then wait till the stock price recover, right? So for example, if you invest in, I don't know, Netflix per se, and the Netflix price drops by 50%, you don't get extra income. You kind of have to wait for it to recover before you can sell to make a profit, right? Whereas dividend investing is like, oh, okay, the stock goes down, so what? I'll collect my dividend paychecks every quarter or every month, depends on what kind of stock it is, and then just wait for it to recover. And that, for the most part, has worked pretty well for us, right? And that's where in dividend investing is great. Like I think we all have heard a lot about this index investing versus dividend investing debate, where people are like, oh, you're investing dividend stock, that's stupid. Why not just do index? But there's so much behind the psychology of investing, right? And that's why when I tell people, like, you don't really know how you'll react until you start investing with your hard-earned money. It's totally different when you're playing. Like, I know there are online trading simulations where they give you, I don't know, like 50,000. You could see how well you do, but that's completely different than investing with your own $50,000, right? Like, if your $50,000 all of a sudden drops down to 25,000, a lot of people can't sleep at night, and that's a problem, right? So
you start calculating how many hours it took you to get there,
exactly.
or how many years.
So this is where dividend investing, I believe, has a leg up compared to index investing, right? Because you're getting this regular distribution, and it makes you sleep better at night. I think, at least personally, that's how I feel.
even to the contrary, over time, I actually get sad when the prices go up of my holdings and happy when they go down, because I can get more of this quality at a lower price and a better yield.
Right. But I think like we're hybrid investors. So we invest in both dividend paying stocks and index. I do see index because you kind of want to do best of both worlds, right?
Yeah.
So index give you that diversification, both asset wise and geographically, right? Whereas individual dividend stocks give you that income aspect. So, some people prefer one over the other. We kind of meet in the middle and we wanted both.
So in Canada, can you just buy American ETFs?
You can. You could buy both the Canadian market and the US market. Now, if you buy US stocks that pay distribution or dividends, there's usually a 15% withholding tax. But if you hold US stocks in we call it RSP, Registered Retirement Savings Plan, it's kind of like the 401k of US, then that 15% withholding tax doesn't apply.
Oh, nice. Yeah, because we can buy US stocks, right? But in Europe, we have this kind of thing that our governments they think we're a bunch of noobs. So what they did is they introduced some policies. So every ETF needs to have a key investor document, and that's why we don't have access to, for instance, the Vanguard Dividend Growers in ETF. We don't have access to the Schwab one, because they need to be a registered UCITS in Europe. So we get all the inferior ones at double the costs effectively.
Oh, that's unfortunate.
Yeah, so for us, ETF investing is not so attractive from that point of view, because if you then go to all the ETFs and you analyze them, most of them are not growing their dividends, actually the dividend income over time.
Right.
So that's the pity thing about it. And if there are one or two of them, like the ticker symbol FUSD, but then they're like yielding 1% So it's again not really allowing you to retire early if you wanted to.
Right.
So we are always jealous about this.
Yeah, for sure.
And then how much this how is it the fees, the transaction fees and the commissions play a role in your investing? Because of course, I guess when you started, how much did you pay for a commission at the time? And when was it? 2008, 2007?
Yeah, it was $9.99 a trade, I think. I think in Canada depends on the financial institution you use. So there are a few discount brokers that don't charge any trading fees. There's one we use, Quest Trade, which charge $4.95. We also use TD, which charges $9.99. So commission is something you don't want to pay so much. What I usually do is making sure the commission is less than 1% of the overall transaction cost.
Yeah.
So usually when we trade, we trade more than $1,000 at a time, or or so on. So that's the idea. Now with these free commission trading brokers is great. That those are like game changer, especially when you're young and you don't have a lot of assets sitting around. That allows you to build your portfolio slowly over time and allow you to build like small amount of money, right? So that's kind of nice.
Cool. So you touched on it earlier, and I think this kind of inspires a lot of people that you are close to reaching financial independence. I think you set a target of 2025, but you mentioned you're closer to that. How did you calculate that, and did it stick? Did it go to your plan? When from day one, did it kind of go to how you planned it to be?
Yeah, I mean, again, I mentioned I'm a bit of an Excel nerd, so I did a lot of simulation and calculation. We've been tracking our expenses since 2011, and over time we found that we spend about $50,000 to $60,000 a year it's been in the lower side of the 50,000. So I've always thought, if our dividend if we could generate about 50 to 60,000 in terms of dividends, we're good, right? And then, I haven't published my December dividend income, but in 2022 we received a little bit over $42,000 in dividends. Now that's including U.S. and Canadian dividends, and for U.S. I don't exchange it back to Canadian currency. I just do 1-to-1, just keep the math easier, because when your currency is fluctuating over time, it kind of gives either arbitrarily inflates your dividend income or deflates it a little bit. So I just do 1-to-1. So yeah, we receive a little bit over $42,000 in 2022. So if you really convert US to Canadian, it would be higher. But if we look at our core expenses, it actually, that 42,000 covered over 100% of our core expenses last year, right? And by core expense, I mean like the expenses like grocery, utilities, housing, stuff like that. Not the non-discretional expenses. By that I mean, like eating out, massages or vacation or charitable donations and educational courses. So from a dividend income, like living off dividend income point of view, we're getting pretty close, because our dividend income could supplement our core expenses, right?
Yeah. So you're really covering your needs effectively, and your wants are still like something to think about, I guess.
Exactly, but we're getting there. And plus, if we when I talk about, I know FIRE is a very big movement, but for us, it's always been, hey, let's reach financial independence, and we'll decide what we want to do. I don't think we'll ever, just stop working all of a sudden, right? It's about doing things that you enjoy doing, whether you make income or not. That's kind of like a bonus.
Yeah.
So for us, at least initially, even if our dividend income could cover all of our expenses, we'll still continue working part-time probably. So there's that buffer, that flexibility there.
Yeah, and I think the community actually agrees a lot with you in the thinking here, because I put a poll actually this week about this, and it asked like, what will you do once your passive income covers your expenses? And actually 44% voted with keeping the job. Yeah, and then 27% said change the job, and only 22% said quit work. And that's really interesting, right? Because I think many people seek more the financial freedom part of it, that they are free in mind and can make the choices they want, rather than lying at a beach drinking margaritas, right? I think we will probably all enjoy that for 2 weeks, but not for 365 days a year.
I think it just gives you more options, right?
Yeah.
You're not too, like, for example, if you have a dividend portfolio generating $50,000 a year, and you just see that you work at Google and you just see this layoff, you're like, well, so what? If you get laid off, you might get a package, right? So either way is fine. You could stay on your job and make a lot of money because you work at Google, or you get laid off, you get a nice package, and you live off your dividends. So again, you're not no longer so worried about your job, because for a lot of people, your job is your primarily like the key income, right? So when you're generating your own income, lots of options open up for you.
Yeah, for me, it was actually quite a game changer already early on in the journey, because being free from debt, let's say, and being free from worries about money because you have your freedom fund, also, makes me really resilient to these kinds of things at work. Because, like you say, okay, package, or if and then what? Okay, I'll just boost my dividend income and find a new job. right? But it made me not worry about these kinds of things, and I think it makes people generally also more mentally stable at work. If you're, let's say, how we say it in Europe, leveraged to the tits with a mortgage, and then you need to depend on every cent that comes in, yeah, that's of course, really adding to the stress for many people. So just financial freedom already, I think, is really liberating.
Yeah, I think it's awesome that you're effectively there pretty much. But was there any struggles along the way? There must have been some sort of struggles, or did you suffer FOMO when we have this high growth investing phase or anything like that? What was the biggest struggle you found?
Well, I think the biggest struggle for me personally, I've always been a saver. Like, I try to save as much as I can, and that's probably from growing up in an Asian family. Like saving is like driven into our mind from early on, right? And my wife, coming from Denmark, she's pretty good with saving as well, but probably not as extreme as me. Like I was pretty extreme, and with Denmark, there's this concept called hygge. You probably heard about it. It's about like, enjoying life and really, sit down and, enjoy the nice moments in life. And, when we start dating and when we got married, like one of the things that I really struggle is, spending the money on these nice things, right? It's not like big expenses, but like, go out for a nice coffee or go out to a bakery and just sit down and enjoy the bakery, or go for chocolate. I was like, well, we could invest that money instead of eating these things. But over time, I understand it's not about just chasing that investing mentality, that extra income. Is also, you need to be able to enjoy your life now. And that message really became really important, especially through work and with my friends. Like, a few coworkers and friends like died unexpectedly, so it's very sad, and that really reinforced the message, because like we kind of take it granted that we'll just wake up tomorrow, but you don't know, right? Like there's no guarantee, right? I mean, it's a good way to go, because there's no suffering, because you just die in your sleep. But if you don't enjoy your life now, you're always thinking about tomorrow, and you'll just do this thing next time, or that it's not healthy, right? So that's kind of my biggest struggle, is like, how do we allocate our money such that we're investing for the future, but also enjoy our present life right now. And over time, that has shifted a bit for me. So that was probably the biggest struggle in terms of this investing journey.
Sort of like a pay yourself first, but also in an enjoyment kind of sense.
Exactly. Well. Like you could pay yourself first, and then you kind of like, and then I want to save like 99% of that income left over. But it's like, well, that's not how it works, right?
Well, to also benefit from that view on life, I would definitely recommend having a look at Service Corporation International. I don't know if you know them, but it's a dividend stock from the US. It yields 1.5% approximately, but they are really in the funeral and cemetery business. So they do everything in this end to end. So when a person dies, they can look after everything, and they charge a lot, even up to the flowers. So from that point of view, I think it's a really stable business, specifically with the boomers coming up. So it might be a
just on the same idea as kind of like retirement homes and stuff like that, right?
Yeah,
although
exactly.
The retirement homes got hit pretty badly during the COVID times, or when COVID started, because they were just not ready to handle COVID. But that's another industry, I think.
I think they died already before they came, for instance, to the last mile house, right? So I am investing in Omega Healthcare. Yes, they're of course under severe stress here. Yeah, but I mean, it really resonates, right? I think, and I know I see this more in the community, having a saver's mindset sometimes also so one is enjoying life, right, and being in the moment instead of borrowing it from the future, I guess, as we say. But also what I observed is, because I have that also a bit this frugal mindset, there is also therefore not willing to overpay for stocks and not always appreciating the quality of a stock. And I see that in my portfolio as well. From the early days, I've got more like the higher yield is in there, or the turnaround plays, and just hoping that the company would turn around. And so there's still a learning curve that I'm currently going through. Have you also experienced such kind of things here?
Yeah, a little bit. I mean, you know how when you buy stocks, you could either do market order or limit, right? And early on during my investing career, I would be like set the limit to like, 5 cents or 10 cents under the ask price, right? Or something, and thinking that I want to really get the best price possible. But I wrote an article on my blog, and I can't remember the title of it, but it kind of talks about this, right? So, for example, say you believe in Apple, you think Apple is such a good business, is going to continue to grow and bring in revenue and pay dividends over the next 10, 20 years. And say Apple is at $150 right now. And for the life of you, you think you only want to get into Apple at $110 a share. And you're just waiting for that price to hit before you hit the buy button. And say one day Apple all of a sudden drops to $111, but it's $1 off your price target. And you're just like, you're so set on this price target. You're like, I'm not buying anything. I'm going to wait for 110. And then the next day the price goes up, and it keeps going up for the next 10 years. Would you be kicking yourself for missing this opportunity?
Of
right?
course.
So there's this, price target, but there's also, on the other hand, it's also about this overall market, the company, and the future profitability, right? Because obviously you don't want to buy something that's way overpriced. So if I don't know, if Microsoft is trading at $600, a P ratio of 70, that's probably not something you want to buy right now. But if it's historically it's been trading at 20, and like $1 or $2 or 50 cents here and there, a penny here and there, it's not going to matter in the long run. You know what I mean? What matters is if you're actually invested in that company and reaping the benefits of being a shareholder, right? Because if you don't hold it, you don't collect the dividends. Right?
Yeah, that's true. So how I try to fight this is actually sometimes if I see myself doing this behavior, because I have the tendency to do this, I either buy directly and then think like, then I'll just don't go for an expensive lunch or something like that to compensate it, so that I still get this quality business. Or I just start calculating, how would it look like with a 7% dividend hike, which might come up in the next quarter, right? Because often also yield is a combination of my buying price as well at times. So that helps me a lot too.
Another example is like, some people say they only buy when the market is down on that day, right? but it's like, well, if it's down today and you buy it, how do you know it's not going to go down more tomorrow? Or if the market is up and they're like, oh, I'll wait for the next day, how do you for sure know the market will go down next day? That's kind of, it goes to the question of, do you do a lump sum investment, or do you spread it out, right? Say if you have a big chunk of money, do you lump sum it or you spread it out? And again, I wrote about this on my blog. I think it comes down to what kind of investor you are. For me, I sleep better at night if I just do a lump sum, because I stop second guessing myself. But some people like to spread it out, which is fine. But I wrote about this on the blog, and I do coaching on the side as well. I tell my clients is that if you want to spread it out, fine, but set up a rule and make sure you follow the rule flawlessly. Because say you want to spread it out, so set up a rule saying, I want to invest X amount of money. on, I don't know, the second Wednesday every month and just do it. Because the danger here is if you spread it out and you tell yourself, oh, I'll buy on the second Wednesday every month, and then that Wednesday the stock market tanks by 20%. You're like, oh, I'll just wait another day, see if it tanks more. And then you keep waiting, or vice versa. It goes up 20%. You're like, oh, I'll just wait another day, see if it comes down so I could get something cheaper, right?
Yeah.
It's basically like that. And so it just find a business that you think is going to be profitable. Make sure your valuation isn't out of whack, and then just figure out your entry point, right? Like if you have, it's better to, my view is it's better to have money invested than sitting on the sideline for a very, very long time.
Yeah,
right?
true.
So for example, in February 2020, when COVID was started to spread, there's a lot of uncertainty, the market started tanking. We put in a lot of money in at that time. There were a lot of discussion with my dad and friends. They were like, should we sell now and then invest later when the market tanks or bottoms? I'm like, well, you don't know where the bottom is. So during that time, we kept buying on the way down. And then I think the market bottomed out around March 20th or 21st. I think we didn't buy anything on that specific bottom day, but we bought like maybe a day before and a day after, or within that window. And if you look at our purchases in 2020, I think we're up like 25% or more as of today.
Yeah, so, that was a golden time to buy.
Yeah, it's a golden time to buy. When again, Warren Buffett's I think he had a quote is like, I don't know, be fearful when I can't remember the quote, but it's basically take the opportunity when people are scared. That's the opportunity to buy things.
Yeah, I would love to go back to that time. No, but you make a good point about lump sum. So because we get bonuses at work, what I usually do is just I top up my money on a monthly basis. So I split it out over 12 months every year. I top up my monthly investment account, and that's what I just invest. But you're right, you need to have the discipline for it. If you don't have the discipline for it, then I think you don't benefit from, how you call it, time value of money. Yeah, because you will be just like, your money will be doing nothing and the stocks will just going up, and you in a bull market, right? And you will only feel more like, oh, I should have invested earlier, and let's now wait for a down day.
Yeah, I mean, one thing I really regret was back in, again, financial crisis. That's when I started really working in, started my career. And back then, I think like Royal Bank, like the Canadian banks went down significantly, right? Because the financial crisis. I think I'm just looking up right now. I want to say Royal Bank was around $30 at one point per share. And I distinctly remember my manager said he's planning to just, go all in on the Canadian banks because that was like the golden opportunity. I did go in. I think I rolled about, it was around at one point it was like less than $30. I think I bought something around 30, the low 30s, and then it went up to like, I don't know, mid 30s or a little bit under 40. I was like, I panicked, I sold. But back then, if I knew, I should have just bought like the Canadian banks like crazy, right? Because if you look at it, if you could have bought at $30, right now is a little bit over 130. You're looking at 4 times plus all the dividends, right?
Yeah, crazy.
I think it's a good time to ask you. I mean, as Europeans, we have very different views on banks, particularly after the financial crisis. But we hear a lot about Canadian banks. What makes them different?
Yeah, I think Canadian banks are well regulated. First of all, I mean, if you look at the financial crisis, they were like, if you look at the American banks, they all cut dividends and suffer a lot. The Canadian banks did not cut dividends, or at least the big 5. the TD, Bank of Montreal, Bank of Nova Scotia, CIBC, and Royal Bank. All these 5 companies have been paying dividends, uninterrupted dividends, since the late 1800s. Now, let me repeat that again. Uninterrupted dividends since the late 1800s. Last time I checked, that's over 200 years. Uninterrupted. Sure, they don't raise dividends every single year, but they kept paying for the last over 200 years. I mean, that's a pretty good track record, right? Whereas you look at the American banks, a lot of them stop paying dividends. I think the European banks as well. Now, obviously, with the high mortgage in Canada, that's always a concern. But I think the Canadian banks are relatively conservative. They've been putting money aside in case there's any defaults and stuff like that. And that's why they did during the first couple of years of COVID. They put aside billions of dollars for loan reserves in case loans get defaulted. And turns out they didn't need that much money. So what happened last year? They raised their dividend payout significantly higher than usual. And who gets rewarded? The shareholders. Right?
Yeah. And I said, from what business are Canadian banks mostly earning, and what are the growth factors that makes this sustainable growth?
Yeah, a lot of the Canadian banks are in the US now, right? Like the rapid fire, you asked me BMO versus TD. I picked TD because TD is, I think now is one of the big banks in the States, right? Royal Bank, not just in Canada, but in US, and they also have some branches in Europe as well. So they're growing internationally. Another thing to consider with banks, at least my point of view, like with Canadians, a lot of times you start banking because your parents bank with the same bank, and then the likelihood for people to switch banks is not very high. You rarely hear people switching banks regularly, right? Maybe once or twice, but very, very rare. So these Canadian banks have a very, call it, loyal customer base. And what's the bank's business model? They take in your money and then they loan out money to other people and then make money that way, right? So if banks are not making enough money, they'll just raise the minimum deposit requirement, or they raise the monthly fee. That seems like a very easy business model to me. So that makes sense to me. Now the other European banks and American banks, that may be a different story, right?
Yeah, I think also for the European banks and such, you just need to go to the violation tracker. And I think it shows also a story, because over the years, a lot of fraud has happened over here. And I think in America as well, I believe is Wells Fargo, I think is a really great example where what did they needed? 7 or 8 accounts per individual. And many of them were fake, and people getting into financial problems even because of that. So there's maybe also something in the culture that is based on greed and such that might be more specific in Europe and even America, I think.
Cool. We might ask one more question, just finish with a little bit of a European flavor. We know your wife is Danish. Do you own any Danish stocks in your portfolio?
She does on her side.
Good.
I think her dad invests, I think, like Danish bank or something, but that's doing terrible. And I don't think it pays any dividends. So she just holds them because she got them like when she was young. But other than that, we don't specifically invest in any Danish stocks. I was looking at Nordisk.
Yes.
Thought about it, but just always found there's other companies that's better than investing in NVO. So I mean, that stock seems to have done well over the last 5 years. I'm just looking at the
Novo Nordisk is probably the most iconic and best Danish stock out there.
Yeah. Yeah.
Because it does everything around, what is it? Is it diabetes? Yeah, I believe everything around diabetes and such. So and that's of course also a growing disease area, and they have just the best products to fight that. The thing is just the price of the share price. It's so hot all the time that it's really hard to find an opportunity to buy it. And once it dips, you're in a candy store, and then Novo Nordisk does still not, from a yield perspective, maybe look attractive. And that's the issue sometimes as well, right? Let's say at the bottom of a market, we just refer to 2020. We often say like, we want to buy the highest quality stocks at the bottom of a market. But then, they go maybe from a 1% yield to 2.5% yield, but then you have all these 3% yield is at 5% yield. So this is really difficult, right? Because it's a big candy store at that moment in time. And that's why I guess Novo Nordisk doesn't pop up so easily.
And that exactly that's what I meant, is like when the opportunity comes, there's always seem to be other stocks that are more attractive than Novo Nordisk, right?
Yeah. Oh, nice one. Well, I think it's something really for the wish list. I would recommend your wife at a certain moment, even just to as a kind of a patriot, just buy one share or something like that.
Yeah.
And I forgot also still a question, because on your blog you mentioned like once you would reach that financial independence level, there was something around living in some different countries around the world. I'm just curious, like what kind of country skips your mind where you would like to just spend some time for a while?
Well, we wanted to live in. I'm from Taiwan, so we wanted to live in Taiwan for like a year or two. We love to move back to Denmark for a year or two, just for kids' sake, learning the language, and just get to know. They could learn about what Denmark is like, or Taiwan is like. Obviously, that's the ideal situation, but with taxes, it becomes a bit tricky. I think living somewhere in Southeast Asia would be awesome, like Vietnam or Thailand, or maybe not Vietnam. Thailand is one hot spot for a lot of the retirees. Even South America, right? Like Argentina, I heard really good things about it. Even some of the Eastern European countries where the cost is ultra low. I think we always love traveling around, so I think being sort of location independent would be awesome, but I don't know if it's a realistic goal at this point, especially having two little kids, and they probably want some sort of stability a little bit as they grow up. So we'll see. We don't have a set plan. We kind of will see how everything goes and figure out as we go.
Well, the nice thing is, I believe Portugal is really attractive to live as an investor, and also Spain has introduced some laws, I believe, to support digital nomads in a really tax-friendly manner. So also really nice country.
I think for me to live in EU, I had to figure out my visa situation, because my wife has a Danish passport, so do my kids. So I'm kind of the only one that can stay in the EU for extended time. So we need to figure out, and the Danes have very, very strict policies in terms of letting people stay in the country for extended period of time. So we just have to figure out the different rules. And
so most European countries, if you're married to the national, to the local, you get automatically via marriage. You can also get your permit. I'm an example of that.
Yeah, that was the same case for Canadians, but that's not how the Danes work. We have seen news about like say American marry a Dane and live in Denmark for 10 years and just got kicked out of the country because they changed their rules, it's a shame.
Yeah, crazy. Cool. We might move on then to some questions from our community. The first one's from Jeremy. He loves your stuff, following your blog for quite a while. He wants to know, if you were able to start dividend investing all over again, what would you do differently, knowing what you know now?
Yeah, first of all, thanks for the support, Jeremy. I would avoid falling into the dividend yield trap, right? And actually understand the companies more. When I first started investing, definitely investing a lot of high yield stuff that are not, just doesn't make any sense. And obviously the dividends get cut and learning hard way. So I would do it differently. And also listen to my guts a little bit more. Like, you know, I missed the opportunity to invest Apple when iPhone came out. I actually like a few weeks after iPhone was announced, a coworker of mine got his hand on an iPhone, and I got to play around with it. And we both thought I was like amazing, and we even joked about, oh, we should invest in Apple, but never did until later, and kind of missed the opportunity, right? So, kind of listen to your intuition a little bit more. I think that would be a lesson I would do differently.
Cool, good answer. Nakil has asked, what is your opinion on ticker symbol CNQ? I think it's a Canadian Natural Resources stock.
Yeah, they're the Canadian Natural Resources, a pretty big company in Canada. They, it's a oil producing company. We own it. It tanked quite a bit during early on during COVID, because obviously nobody was using oil, so the company suffered quite a bit. But now it's pretty high. With energy stocks, it's quite cyclical. So if you do, grow your portfolio to a higher percentage in energy stocks, just be mindful that they're cyclical, right? So it could be high for a few years and then could be low for a few years. Just depends on the war economics. But generally speaking, I think it's a solid company. Just depends on your entry point.
Nice. Jacob has asked, he can't seem to find your portfolio on your website. I don't know if you publish it, but maybe you could give us your top 5 positions.
Yeah, it's actually under, I have a link on under my menu called Dividend Income, Dividend Portfolio. So I list all of our holdings there. So top 5 would be, I don't track it every day, but it's basically iShare X Canada International ETF, TD, Royal Bank, Apple. I think it's either between Enbridge or National Bank at this point.
So Bob, about Enbridge, right? I've been looking at it several times. I'm just wondering, like, something is stopping me, and I think it's because of the high yield here that kind of pushes me away from the stock. But what is, in your opinion, kind of the bull case, or why do you own it?
Yeah, Enbridge is interesting, right? So if you look at it from a payout ratio point of view, it's over 100%. But Enbridge is kind of unique in the sense that you kind of have to treat it as a utility company in some sense, and you really need to look at the adjusted FFO and also the free cash flow to figure out their dividend safety. I think for the most part their dividends are safe, and they've been raising dividends pretty consistently. Right now, my case for Enbridge is that if you look at the Enbridge business, what do? They transport crude oil and natural gas across North America. What do people use primarily to heat their houses in North America? Natural gas, or I guess crude oil for energy producing as well, right? And that's not going away anytime soon, right? What's one thing that the Europeans are kind of suffering right now? The high energy prices. I heard all about it when I was in Denmark. how only government-owned properties are turning down the heat to, like, I think 18 or 19 degrees, and people are cold working in there, and lots of discussion on that. And how people are turning off flights, and apparently there's like a 30% reduction in energy consumption or something. anyways, so with Enbridge, I think just because the North Americans use natural gas to heat their home, there's a need there. If you look at from a macro point of view, what's one thing you have read in news in the last few years? These new pipeline projects keep getting rejected because environmental concerns, or mostly environmental concerns, because there's a lot of protests. So what does that mean to the existing Enbridge pipelines, their pipeline networks? All of a sudden, that network becomes more valuable than ever because you can't build new pipeline networks anymore, right? So what you're seeing in this pipeline industry is these big companies taking over, like acquiring these smaller companies, right? So for example, Inter Pipeline a few years ago got acquired by Brookfield, right? Because their share price tanked, and then Brookfield, being Brookfield, they saw that as an opportunity to sort of doing a hostile takeover. So they did that. So you're seeing a lot of these companies starting gobbling up smaller ones. So that's my bold take. Now, would this change in the next 10, 20 years? Possibly, because as we shift away from carbon resources to renewable, I think that might change. But Enbridge is also changing their way to operating as well. They're now starting to invest in more renewable energy assets as well. So the company is going to evolve over time.
Okay, thank you.
No problem.
Nice one. Ron has asked if you could comment on ticker symbol OTX, and I think they are Open Text Corporation.
I don't follow them too closely personally. They're every time, kind of like Novo Nordisk. Every time we looked at it, we're like, oh, it looks nice, but there are other opportunities for investing our money elsewhere, right? I think I would categorize them as lower dividend yield but very high dividend growth. Just looking at some numbers here. Give me a second. I think they have raised dividends pretty consistently over the last few years. The yield is about 2, in the mid 2, so it's attractive enough. But again, if you're looking for yields, 2.5% may not be that attractive to some investor, right? But the high growth is interesting. So it has a 10-year dividend growth streak, a 5-year dividend growth rate of 12.7%. So it's a decent growth. But again, like, will I own it over the Canadian banks? Probably not at this point. I don't know. I just think there are other better companies to invest than OpenText at this point for us. Now it could be different for this listener, right?
Yeah, and on top of that, I find their products not exciting enough to own a piece of their business. That's maybe also a good one. I think most people hate their products as an employee in a corporate because it's all about finding documents that you don't find, or you get chased by the record management department to do the version updates. So it's bad affinity.
You kind of have to also need to understand what the company does, and you need to be able to be excited about the company in some sense, right? Like I'm a really big believer in Apple, right? I could go on and on about Apple, but if you think about it, like, why is Apple so good? It comes down to its ecosystem, right? How many people do you know has an iPhone and other Apple products, right? I know quite a few, and I actually know quite a few people that used to own an iPhone, switch to an Android phone, and then a few months later switch back because they can't get away from iMessages, right? Yeah. And then if you look at the whole Apple silicon, one thing I noticed, if you look at their latest releases, except for Mac Pro, all their computers and laptops are not user upgradable anymore. So when you, as a consumer, this sucks as a consumer because you have to invest so much money for your brand new laptop or computer or desktop. But as a shareholder, it's great because what Apple is forcing consumers to do is you have to make that initial investment of, you need to upgrade your RAM, you need to upgrade your hard drive or flash drive, and making, because everything is integrated now, right? You can't just open up the laptop or computer and put your extra RAM or upgrade your hard drive anymore. You have to make that decision now, and Apple is charging an arm and a leg for these upgrades.
Yeah.
So from a shareholder point of view, I'm like, this is great,
Exactly.
But wait till I need a computer. I'll complain a lot about this business model.
When it eats your dividend income.
Yeah.
Nice one. Bart has asked you about Qualcomm, ticker symbol QCOM. What's your thoughts about the company and its fair value?
Yeah, so we got in Qualcomm quite early. We're actually doing pretty well with Qualcomm. We got in Qualcomm in the low 60s. I share my dividend portfolio, like in terms of what we own, but I don't actually share the cost basis just for privacy reasons. And we don't share how many shares we hold, just again, because my name's out there. Actually, in fact, a lot of my coworkers read my blog, so I'm like, need to be careful what I share in terms of numbers, right? And my friends read about it too. Qualcomm, if you research a little bit about this company, you'll know that they're in the cellular world. They own the 5G technology or 5G world right now. Sure, there's MediaTek, but they're not where Qualcomm is. I know the cellular business pretty well because that's basically what I do for work. Qualcomm has tremendous amount of IP on cellular technology. So, just because Apple buys Qualcomm chips, it's not just the chip. They also have to pay royalty to Qualcomm, and that's like insane amount of money they're earning from the royalties, right? Qualcomm has expanded into they have this Snapdragon processor world. It's picking up. They're also recently at CES, they also came out with a bunch of news about cars. They're now investing heavily into the auto industry, like the infotainment system and the like self-driving technology. Am I bullish on Qualcomm? Yes and no. I think with any technology company, especially hardware centric, there's also always a risk of people overtaking you. Just look at Intel, right? Intel for the longest time was like the leading example of a chip semiconductor company, and they kind of have fallen behind, and they're suffering right now, right? Qualcomm could be there next if they don't continue innovating. But for now, we own Qualcomm. It's a very small percentage of our portfolio, and we plan to continue holding it. Now, I think the listener's question is it a fair value at this point? I'm just going to look it up here. Now at $123 at a P ratio of 10.76, I would say yes. I don't know what their historical P ratio is like at this point. At 2.44% EO rate, that seems pretty decent in my opinion. Now, if I just look at the U.S. dividends champion spreadsheet, that's a very nice spreadsheet for any dividend investor. Just looking at Qualcomm, they have raised dividends for 20 straight years. At a 10-year dividend growth rate of just under 12%. Payout ratio is pretty normal. Yeah, I would say it's at a fair value. at a P ratio of 10 point in the mid tens for a technology company. I think that's pretty fair.
Cool. That seems fair. Dividend Yogi has asked a question for maybe both of you. What's on your shopping list in the near future?
I'll start. I started looking at Ahold Delhaize a little bit again. Just wanted to reassess like what the business is worth. It's in my top 5, but I still feel I have too little of it. So Bob Ahold Delhaize is also owning Food Lion in the US. They have their revenue is 60% US and 40% mainly Netherlands and Belgium. So it's kind of the / target of the Netherlands. That's one. And then second, I'm still looking a bit at Texas Instruments at the moment, but I haven't made up my mind yet.
Yeah, I think I tweeted out the other day, we just dumped $30,000 on the shopping spree, and we actually added a bit more in the last few days, or we're up about 40,000 investors so far in January. And listen, might be like, oh, you must make like tons of money. That's not the case. What we do, we save money. Last year, because our tax advantage accounts, we transfer a bunch of money early in January and then try to max out our RSP as early as we can. So usually if you look at our buying trend, is that we buy a lot of dividend stocks in the first half of the year, and then we kind of slow down a bit in the second half. So that's exactly what we're doing. We just dumped about $40,000 in the market. What did I buy? I bought Brookfield Asset Management Company. That's just a new spin-off from the Brookfield. So Brookfield is like kind of like, you could call it like a holding company. They own like these umbrella companies underneath, and the way it was structured, it was never very truly valued. So they spun out the asset owning company and try to do a little bit higher yield. So I thought that's a good opportunity. We also got into CIBC, like the Canadian banks, right? CIBC, National Bank, TD, Royal Bank. We bought a bunch of them. The banks are kind of suffering right now. It has picked up since late last year, but I think the valuation is still pretty low. They're yielding north of 4%. So I mean, why not, right? Especially when we talked about this earlier, they've been paying dividends since the late 1800s. So why not continue adding Canadian banks? Also added some Bill, BCE, and TELUS, T. I don't know if you two know, but we Canadians pay probably some of the most expensive data rate in the world. I was in when we usually go to Denmark, we get a prepaid SIM, and that usually comes at like, a few gig of data for less than $20 Canadian, and here we are paying an arm and a leg, probably $50, $100 a month on data. That's unheard of, right? I was actually in Taiwan in September, and got a local SIM because I had to quarantine for 4 days, and they wanted to track me. So I got a 7-day prepaid SIM, and it had all you can eat data for less than $10 Canadian. So I think it makes sense to invest in telecommunication companies in Canada, because they make so much money.
Nice.
Yeah, and then what else is on my shopping list? I have an article coming up, but I'm looking at Apple just because the stock share has come down quite a bit in the last few months, maybe like the likes of some of the consumer discretionary, like McDonald's, Costco. I like Costco a lot. Every time we go to Costco warehouse is jam packed. and it has a very different business model than the likes of, say, Walmart or Target, right? They're not trying to make margin from stuff they sell. They're making money from all the different membership, right? So that's like high margin. So yeah, those are kind of the stocks I've been looking at.
That's a lot of money and a lot of stocks at the same time. So you must have been busy hitting that buy button the whole month, or the first 2 weeks actually.
I was not happy to see the stock market keeps going up. It's too green. I wanted to stay red so we could get more stuff at a discount, but it's what it is.
Yeah. Like you said, in a few years from now, if these are good businesses, you'll be happy.
Exactly.
Nice. Life with Dividends has asked us, on your blog, you mentioned 3 key questions to ask before making any investment. Could you elaborate on the factors you consider when evaluating to the downside and bear case, and at what point would you consider to sell a position?
So funny this lesson referred to that article. So that's like one of the first articles I wrote on my blog. So for those that don't know, the 3 questions to ask before you investing. The first question is, what is the upside of this investment opportunity? 2 is, what's the downside of this investment opportunity? And 3, I think that's the most important question you have to ask yourself is, can I live with the downside? So when people invest, and I definitely fall into this myself over the years and still do, to be honest, is we only look at the upside of the investment opportunity. We're like, oh, we buy Apple, it's going to be like 2 bigger, 3 bigger 5 years from now, or you buy this investment and you're convinced yourself this is going to return like tenfold or whatever, right? And it may not, but we often don't think about what's the downside of this investment opportunity. Like, can this share price go to 0? Can it return 50%, minus 50% in the next 5 years? And is that okay with you? And what happens if that happens? Like, going back to the example of ING, right? When I first bought it went down 40-50%. Obviously, I wasn't thinking about the downside of this investment opportunity when I bought it, but that was a good learning experience. Now, the other thing, the third question, and I think, in my opinion, the most important, can I live with the downside? I think with investing, there's so much aspect of the investing is related to psychology, right? Like, can you sleep well at night knowing that your hard-earned money may be down 20, 30, 40%? What happens if you wake up and you see the market, like, think back of February, March 2020, like the market is tanking 10, 20% each day. How are you going to feel first thing in the morning when you see those red? Are you going to freak out? Or are you just like, yeah, strike it off, right? Are you going to be depressed knowing that you're losing your money, right? Like, when we were checking our portfolio, we were looking at, $20,000, $30,000 of difference every day. And it's like, ooh, like at one point, in 2020, we were down over $250,000 in our portfolio. That's $250,000. That's a lot of money, right? If you like, and luckily for us, we're like, yeah, it's just paper loss. We're not selling at this point, so we're okay with it. And I think knowing dividends are coming in, it kind of assure us a little bit, and we slept a little bit better. But if you can't live with the downside, you need to really think about whether it makes sense to invest in this stock or not, right? And most importantly, I think there's a tendency to invest with money that you need in the short term. I think I've written this multiple times on my blog and mentioned on various podcasts, is that you want to invest with money you don't need in the next at least 3 to 5 years, hopefully longer. Because if you invest with money you need in the short term, the worst case scenario is you need money, you have to sell, and the market tanks by 20, 30, 40, 50%. And you're like, oh crap, right? Like imagine you invest the money for your down payment, your house, and you just happen to find your dream home in March, like early March 2020. And you're like, oh geez, it's down 40% by needing money. I have to sell.
Yeah.
And you're just kicking yourself at that point, right? So it's always thinking about the long term, and then think about these three questions when you invest. I think that's very important.
I think that they are three really good questions. The issue or the problem I see is that I think people overestimate the risk that they can take because it hasn't happened yet. And I think it's easy to say, oh yes, I can accept the 50% loss. And
Exactly.
I know this from personal experience that before I started investing, I tried some trading and all sorts, and I was successful in some parts of trading, but then when I moved to the financial markets, I thought I could accept that risk. I knew the risk going in there, but it's not until it happened that I realized, do you know what, maybe this risk is a bit too much.
It's easy to talk about theories and how you would feel, but until it actually happens to you, you really don't know what you're going to react. Right?
Exactly. Yeah.
You could plan, you could do lots of plan, run a lot of scenario and all that stuff, but until it happens, you don't know how you're going to react.
On the other end, if my portfolio would go to zero, because from non-investors, that's always what they say, oh, you can lose all your money. My portfolio would go to zero if the companies that I have, I think we are having other problems in the world.
Exactly. Like if the likes of Apple going to zero, or the
Unilever,
like if the 5 big Canadian banks go bankrupt and the share price goes zero, man, like we're in a lot of trouble in Canada, right? Like I can't even imagine that happening because the government would bail out these banks beforehand. Right.
I think Uncle Warren will step in and say, what, give me the 5 big banks, and he gets filthy rich.
That is not going to happen ever, I think.
Dazzy Mike has asked the question. He's also an engineer, and he is Taiwanese and Canadian as well. He's just looking at the current tensions in China and Taiwan. First of all, do you think US are doing the right thing under semiconductor war? And secondly, how does this affect you as an investor?
Yeah, interesting question, especially what's going on with Ukraine and Russia. I think when I was in Taiwan in September, I actually had quite a bit of discussion with my coworkers on this specific topic, and it was quite interesting getting their feedback because they live in Taiwan and had to live through the whatever missile exercises and all those military exercises. My view is, obviously there are tensions between China and Taiwan. That's been going on for decades, and that tension has maybe intensified over the last few years. But in my opinion, it might be a little bit overplayed in the media as well. I do think US is doing the right thing in terms of saying that they will protect Taiwan if something happens. I think it's in most countries' best interest to do that. And Dazzy Mikey kind of referred to the semiconductor world. That's a very, very key reference. Now, during COVID, and we're just getting kind of the end of it. Remember, you probably hear about supply constraint, right? Like, you can't get cars. Used cars are expensive. You can't get laptops. Even if you buy a car, they may only give you one key fob because they couldn't make multiple key fobs because there's just not enough chips available. Taiwan, the Taiwanese semiconductor company, TSMC, they make something like, don't quote me on the number, but I think it's somewhere around 80% of all these chips are made there in Taiwan. So your Apple iPhone, your Android phones, your laptops, like Qualcomm uses them, Apple uses them, AMD uses them, bunch of companies use them. If you think the supply constraint was an issue during early COVID time, just wait till there's a war between China and Taiwan. Like, man, your crappy car will be like probably triple or quadruple in price because there's no supply available, right? So I think it's in these countries' best interest to protect Taiwan. And I'm hoping there's not going to be a war for obvious reasons. But yeah, I don't know. I don't know what's going to happen. But for me, I don't think it's something we have to worry as an investor. I think obviously there's some dangers of not getting enough chips if something were to happen. But that's not something we could do, right? It's kind of outside of control. I think as investors, we need to remember there are things that outside our control and things that we could control. The things we could control, we need to make sure we could control them, right? Meaning like how much money you invest, whether you buy or sell stocks on a whim. Like if the market's down, don't just sell all of a sudden, right? I knew people that sold at the bottom of the market in 2020 because they were like, it's going to go down even more. And then they didn't buy back until like September of 2020 when the market was like already up like 60-70%. And I'm just like, oh, and the funny thing is some of these people were doing like 60% stocks, 40% bonds. And then during that time when the market was going down, they were selling bonds and then buying stocks, which was the right idea. But then they just started, they then started selling stocks as well. And then they went all cash in like March 2020. I'm just like, oh man, that's going to hurt, right? So again, like I said, control things you could control, but there are things like how is Apple going to make billions of dollars? Yes, but how much are you going to make? You can't control that, right? So control things you can control, and there's always political tensions and news and stuff. So try not to worry too much, right?
And that's also where diversification helps.
Exactly.
Good. I think this is a question for me, guys, and that's from Wolf of Harcourt Street, and he's asking if we have any thoughts on LiveChat, which is a Polish company, highly profitable, with high growth rates. So no surprise that our Irish friend is interested in it. Look, it is correct, right? The dividend growth rate has been really stellar compared to, let's say, 8-9 years ago. It went up from, I think, 37 groszy to 4 zloty and 40 groszy. So that's more like 12-13 fold. I just struggle a little bit with the business model with LiveChat. I understand let's say the business they are in, right? But what I struggle with just is that I don't have enough feeling for this kind of part of technology that this is sustainable business in the next 10 years. And even with open, I said ChatGPT and everything, I just don't have enough conviction in a stock like this. If I go for tech, I usually like to go for blue chip tech stocks in my dividend portfolio and not for the niche players. And that's why I'm not interested in it, although their dividend growth rate looks stellar, their business is on fire. In the end, it's a niche play, and I don't need that in my portfolio.
Right. I can't say I know the company at all, but just hearing what you said, I think if it's very, very niche, there's always a danger of somebody could come out with a similar product and taking over, right? Like a big company could just all of a sudden decide to get into that sector, build something similar, and that's the end of that company, right?
They're in the business, let's say, of customer interaction automation, let's say it like that. Right. So live chats, chatbots, help desk ticketing systems for managing emails and such, and having knowledge bases for when you're in contact centers and such. So of course, if you can automate this, you're really saving money for the companies. But again, it's still a niche for me. I think now natural language processing and such, if we see what ChatGPT did, OpenAI, they can build probably like layers on top of that. But I just don't see that these kinds of businesses have a strong moat. And maybe I'm wrong there, but it's for me not enough to start having a deeper dive into this business.
Yeah, I think I generally agree with, if you want to buy tech companies, going with the big players, because it's I think there's just less risk, especially with the high tech, like in high tech, right? Like the Microsoft, the Apple, the Cisco of the world, they're going to be there for a long time. There's no danger of all of a sudden, they disappear or somebody taking over them. It's going to be pretty tough, right? So there's that. With the way high tech work and tech companies, like, things will change very fast, but the smaller players are usually that kind of suffer if something changes, and kind of putting yourself in a very specific niche, that's kind of dangerous as well.
Okay. Dividend Gardener has asked you, Bob, what do you think of Severia as a dividend growth investment? I think this ticker symbol is SIS.
We don't own it. I have written about it before. Like I think I listed Severia as one of the best Canadian monthly dividend stocks. Again, it's I mean, we currently own 49 different individual dividend stocks, and I will be the first one to tell you that's maybe a little bit too many. My goal this year is to reduce it to about 45. Ideally, we want to own somewhere between 30 and 40, but there's just so many companies out there that are so solid, like, it's really difficult, right? I think it's an interesting segment. Severia is a global leader in accessibility, right? So they're manufacturing products and modifications such as stair lifts and wheelchair conversion kits. And as the population age, and we talked about this, like funeral homes earlier, that this business models make sense to me in my head. Like, obviously, as people get older, they need to be able to move around. So, these kind of things. But again, it's such a niche area. I don't know if I'll invest them over some bigger companies, right? And this is where you kind of have to pick and choose, right? Maybe if you decide to invest in Severia, you invest maybe like 1% of your portfolio. You don't put all your money in this particular company, because I think there are other company that might be better. But if you want to bet on this company doing well in the next 5-10 years, you could invest in a small amount of money and see how that does, right? But yeah, like we currently don't own this company, and no plan on owning it, but I've written about it. I think it's a solid company, just depending on your investment strategy.
Yeah. Everyone loves a monthly dividend payer as well, don't they?
Yeah, but I think I don't know what's the fantasy about monthly dividend payers. Like, I get the idea of it's a stable monthly dividend income, but I mean, there's nothing wrong with every quarter. Like, I don't know. I think there's
annual.
Nothing wrong.
Or annual, like in Europe.
Right. There's nothing wrong with as long as you get the dividends. Who cares if it's annual or quarterly or every half year or monthly? As long as you get the money, sure. Maybe you, like, I get it. Maybe from a expense planning, income expense planning point of view, it would be nice to have a stable income each month, so you could spend what you get. But that's no different than, say, you do a 4% withdrawal when you retire. You don't withdraw 4% every month. Usually, you take a big chunk of money and then you allocate how much money you would spend each month, right? So it's no different than having a dividend stock paying once a year on dividends. Just you just need to plan it accordingly, in my opinion.
It's all part of that psychology that you were talking about earlier. It's all. I suppose if you're planning, if you're living off income, it's probably easier to have a monthly paying stock than quarterly or as we have in Europe annually.
Yeah.
Okay. The last email then, last question came in by email from Erwin, one of our Dutch listeners, and the question he has asked is: so suppose he buys a stock for €10 and the dividend is €1. So his yield on cost is 10%, which is pretty easy.
Mm-hmm.
The next year, the dividend is flat, it stays the same. Is his yield on cost still 10%? He argues that it is now 11% because he's received that €1 in dividend.
No, it will still be 10%. Your yield cost is it's per year. It's not like if using his argument, that means if I had invested a stock in 10 years, my yield on cost would be way over 100% because I collect all these dividends over the years, right? A yield on cost is just at this, it's kind of looking into the past. It's like, well, at the current time, if the company is paying €1 in dividends and you purchased, say 10 years ago at $2, what's the equivalent yield on cost? Right. And when I started, I focused a lot on yield on cost, this particular parameter, but it's a nice pat on your back parameter, in my opinion. I don't think it really matters all that much. It just tells you whether the stock you invest is doing well or not, right? So if your yield on cost is really, really high, that could mean a couple of things. One is the company, the share price has increased significantly. And two, the company has continued growing its dividends. That's how you have very, very high yield on cost. If your yield on cost is lower than the current yield, that just means the share price has dropped and you're in the red, right? Yeah, so it doesn't really mean a whole lot, in my opinion.
I think for me, yield on cost is mainly important at the time of the purchase.
Exactly.
But it is a nice metric to track, indeed, just to see, like, more from a performance point of view. And I guess the only time when you can say that the yield would have gone up a little bit, the yield on cost would have gone up if you would have reinvested all those dividends and would look at the net yield on cost, let's say the absolute dividend that you, for instance, got, but the yield on cost, like how it's meant to be here, it would always be 10% just. Yeah, so I can imagine if you increase your share count,
your yield on cost doesn't change because that's the yield at the moment that you purchase the stock.
Exactly.
That would never change, right? So in my portfolio spreadsheet, we do track yield on cost, and not just like a fun parameter to look at it, right? So I mean, some of these stocks that we own are like, north of 10% yield on cost, but does that really matter to me? No, that just means that the stock is doing really well.
The dividend growth matters, and I sometimes would like to see my stocks when I calculate, because of my retirement FIRE plan, let's say. I generally often ask myself how many years will it take for this company to get to 10% yield on my investment price? Yeah, and that's an interesting metric for me, because then I can see, okay, a 1.5% with 10% growth. Will take maybe 20 years to get to the same stage as my 6%er with 6% growth, right? Or 5% growth. So
yeah, for sure.
Interesting. Good. I think we came to the end of the show, right? With with the last question.
Yeah. It's been fun. It's actually longer than I anticipated, but it's been really good discussion. It's always fun talking about dividends.
I agree. It's always fun to talk about dividends. Sometimes time just flies. We find ourselves in the beginning, we thought we'd keep podcasts to about 30 minutes, and it's never been the case. It's always an hour and a half, maybe 2 hours. So this is quite normal actually for them to be this long, but it's been a pleasure having you on the show. I think listening to your journey, where you are, and some of the insights you're given, pretty knowledgeable. So we appreciate you taking the time and spending two hours of your life chatting to us. So thanks very much for that.
Thank you very much for having me on the podcast. Appreciate that.
And Bob, we will for the listeners also, we'll put your blog article, your blog link in the description of this podcast. So if you're interested, definitely give him a visit. We'll also put your social media links on there so that people can follow you, are interesting to continue to engage with you. And maybe we'll also pick one or two of those articles out that you referred to, Bob, and also put them here in the link to the description, because our listeners are often very interested to read up on what we've been mentioning. So I'll make sure that everything is as much as possible in there. I think we'll not be able to put all the tickers in today that would be that we discussed. That would be a bit too much. So please bear with us on that one. But yeah, thank you so much. Thank you so much. It was really awesome.
You're very welcome. It's been fun.
Good. So to everyone then, thanks for staying with us. And I hope, because maybe for you, many people listen us while running. So I hope they got a decent amount of kilometers in today. So and to everyone, see you next week.
See you all soon. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.